Tarun, we can start, right?
Yes, sir. Hello all. Thank you for joining us today. Hope you all are comfortably seated for this webinar. The power law is a statistics rule which says that a small number of items in a given distribution will have an outsized impact on an overall data set. This phenomena branching out in the investment world has spectacular outcomes. Today we have Mr. Jia Balaji, Head of Research and Co-Fund Manager, heading the presentation on this topic. Sit tight and enjoy the webinar. Sir, please take the
Thanks, Tarun. Very good morning to everyone on a busy schedule. You have taken time. The idea behind this session is, as Tarun alluded, right, in our life or in portfolio or many things, a few very important decision makes a huge impact in the entire career, right? And one such law is power law. And just give me a second where I'll put the PPT. Tarun, can you just confirm PPT is on?
Yes, sir. It's clear.
Okay, so if you look at generally, right, what we have been preached, and it applies to most part of our life, called normal distribution, where there will be the bell curve fit in where people, let's take in terms of a salary increment also, right? So people are get paid 5% on an average, and then you have an outlier performer will get 6, 7, 8%, and someone who has done badly will get 2 to 3%. That's how in most part of our life has been looked at by normal distribution. It's fairly good to have a normal distribution, but there are certain pockets of life where the normal distribution doesn't operate, and that is where the power law distribution operates, where a few minority subset takes almost the entire value, or I would say 80 to 85% of the value, right? So something in terms of wealth, something in terms of popularity. If you look at very few people has almost 90% of the wealth or the popularity, right? Clearly, there the power law does where the normal distribution doesn't operate. So in few pockets where power law is extremely useful, and one such area in investing also, we strongly believe when you invest into a portfolio for a 4 to 5 year period, right? Typically, what you end up seeing in a portfolio is 3 components after 4th, 5th year. The first component will be a good portion of the stocks will do very close to the market returns. So that will exactly fit the bell curve, right? Normal distribution, where let's say in a portfolio of a 30 stock, close to 20 stocks will do a pretty average job, right? Neither they will do exceedingly well, neither they do extremely bad. Then you will have 2 to 3 stocks could have done badly, right? Which is on the left tail, where they are underperforming substantially over the market for a very long period of a time. Then you will have 6 to 7 stocks which will do extremely well beyond what your initial expectation. And that is where the power law comes in, right? Where the winner eventually takes charge of the portfolio with initial weights, let's say 3% for equal stocks. As they succeed, right? In a stock, you can only lose 3%, right? When you invest, let's say 33 stocks equally distributed out of 33, 3%. The loser will lose its weight and lose the relevance. The winner, as they become substantial, right, the 3% weight will become 6 to 7%. So all the winners at some point in time will have more weight. They'll influence the portfolio performance significantly, and they actually drive the entire portfolio return. And that's what we end up seeing, this multi-bagger effect, right, in a portfolio, where in every portfolio you need to have few stocks which are ideally positioned to produce a disproportionate return. And that's what precisely power law is all about. If you see a couple of examples around us, right, where power law is extremely prevalent and it gives you a good idea is, obviously, right, Dhoni, who has an extremely disproportionate fame, popularity, obviously what he has achieved it, but we clearly know there are many players are reasonably equal at some level, but then sometimes the fame and the entire capture of value chain is done by few people. In terms of wealth, it's a very, very clear where wealth clearly goes through power law and not a normal distribution. 20% of the people own 80% of the wealth. If we put 100 people in a hall with a 5 lakhs of wealth, the average will be around 5. But suddenly you add Mr. Mukesh Ambani into the crowd, suddenly all the averages will go to more than a couple of crores, right? Which clearly brings out an outlier can change the normal average returns. A similar effect will be seen in the portfolio. And finally, we saw few monopoly company like Apple, like Microsoft have created phenomenal wealth over a very long period, right? So this is where a few company dominating or few people dominating or few of our decisions dominating the most of the wealth and not every single decision is matter, right? So few is actually a better word rather than saying I have to do many things. I have to do few things and I have to do it well. That's a sum and substance of what power law is all about. So how do you build a monopoly company, right? So in a portfolio management, if you have to look for a company which can create tremendous wealth, right? So one of the character is, can they be a very dominant force in the industry? And so the couple of metrics which we should look at is typically a monopoly starts small in their small vertical and they monopolize themselves. Once they monopolize themselves in a small space, they start scaling up. Once they scale up, right, typically they don't disrupt anything. They go under the radar and continue to grow. And finally, you don't have to be first in every industry to be a monopoly. So if you look at today, we use a lot of Facebook, but Facebook was not the first social network which we have used, right? There was Orkut, there were many things before. Whenever people keep consistently talking about first mover advantage, but there are multiple examples of a last mover advantage where if the last mover can come with a great product which solves all the problem of the initial products which has come by competitor and very enduring and actually can capture the biggest market share. We saw in Chrome as a web browser was not the early browser, or even the Facebook, and many examples where sometime the last will be the first, but the last has to have a very significant product improvement so that all the users of the initial product will switch over to the last. So these are the four ingredients somehow we believe can create a platform for become monopoly. Not necessarily with this four you become monopoly. How monopolies generally scale is, first they do a vertical progress. What does vertical means? You create a product from nowhere. So it's basically a 0 to 1, right? Where there is a fantastic book published by Peter Thiel, which is called 0 to 1, which talks precisely on the power law equation, where the companies create disproportionate wealth, where they create something very new, and it's basically a creation, right? So that's where it's 0 to 1, which adds up value. The moment you create something, then you go globalize, basically that 1 to N effect, where if you are selling only in Chennai, where primarily I thought we based out, I'm just giving an example to connect back easily, right? Then you go to Tamil Nadu, then you go to South India, then you go to India, then you go to Asia, then you go to the world, right? Basically, you take a very successful product and slowly and steadily you expand your wings to sell it to more people. The growth of horizontal progress is a little easier because the product is success. You know why your customers are buying into the product. Now you need to make your product available. But the vertical progress is a very difficult piece where you are actually creating the winning product or a winning solution, right? So the best way is a VC, when they see the vertical progress has happened, right? Actually, the horizontal progress is the easiest lifting of the growth. And if a company can execute both the piece, that is where you see an exponential performance in terms of return metric, which I'll share with one global example. Having spoken about how power law is there, it's kicking in multiple part of our life, and we saw some examples of personalities or the company which become a dominant force in the particular industry, and what makes you to build a company like a monopoly. Let's see a company which has created a tremendous wealth in the last 20 odd year. A talk of the town is none other than NVIDIA. NVIDIA as a stock has gone up 1000x in 24-year period, right? Obviously, it's a long enough period, but 1000x multiple is truly fit into what Power Law believes in, where you invest into good company and wait over long period, tremendous wealth is possible. So we thought we'll take this example to narrate what happened in NVIDIA so that there was a 1000x money, right? So someone invested a crore would have become like 100 crores out of it, or 1000, 10 crores, 10 crores, right? So capable, what led NVIDIA to what it is, right? When capability meets opportunity, the mega trend, right? So what happened in NVIDIA is the NVIDIA addressed these four mega verticals in their entire space. So they started with as a gaming, for the chips what they produced was primarily into gaming, which become a very big. Then at 2020, you saw crypto become the big one, and NVIDIA was extremely well positioned. The third, the recent one, which is generative AI. AI has been there for quite some time, but the clear buzz on generative AI again brought back to attention for NVIDIA. And finally, if you look at our automotive space, right, the entire automotive industry is moving to more a tech product rather than a product made out of steel and other metals, right? So clearly, we see this company always actually aligned themselves to a very mega trend, which is not for 1 year, 2 year, but it can play for a 10, 20, 30, 40 year period, right? So they played mega trend of gaming and crypto, and now they're aligning with AI, and they're very well positioned for automotive, right? So clearly, you cannot say they have turned lucky. They can turn lucky once, but they're consistently aligning themselves to what the world need in next 10, 20, 30 year, and not what the world need tomorrow. So when capability and market happens, right? If you see why did market capitalization went the way it is, just look at one of the controllable variable of NVIDIA where R&D, right? The amount of R&D this company has been spent is tremendous, and it's been consistently growing across the time period, and it's actually ballooned in the recent past. So in 2003 itself, they used to spend close to 225 million USD dollars, which is a substantial money, right? And they consistently grown, and last year, as per their annual report, right, they've spent close to $7.5 billion only on research. So think about a quantum of money spent, not looking at near-term impact, but what they can build out in next 5, 10, 20-year period, right? So NVIDIA was always an R&D led company, right? That's where your first vertical progress happened, right? You create something which the world has not seen. For that, you need to put this. So they did this meticulously. What this resulted in a sales growth, right? So obviously, NVIDIA, which was doing close to $2 billion, went to $4 billion. If you see 2008 to 2013, it was consistently around $4 billion, right? So one of the thing which I would like to pass on is, if you have a company which is doing R&D, if you look at R&D expense, R&D expense almost doubled between 2008 to 2013, but the sales did not double. So a company was very clear, I'll consistently invest into the future, irrespective of today's my efficiency of the productivity, right? Where the sales is not growing, but they were always investing into the future. And then if you see from 2013, the sales started picking up again, right? It doubled. And now, actually, 2018 to 2023, it is not even doubled. It has actually become tripled, right? So NVIDIA is actually growing at a faster rate as it getting matured. So this is where you get that right tail event where when a company grows faster, not in next 10 years, after next 10th year, they're going to grow much faster. This is what clearly NVIDIA example is bringing out. And when a company does a good R&D and a sales growth, and look at operating profit, right? Similarly, from a 209 million to $1 billion and 5 years of consolidation, and then you have a right tail, right? You are typically grown your operating profit in the last decade by 7, 8x, clearly reflecting the consistent work what they did, and that resulted in sales and the operating profit. So if you see this 1000x is come out of primarily these operating metrics was chugging all along for the period. But when we see a 1,000 bagger or 100 bagger or 10 bagger, right, we think, oh wow, fantastic. How do you? So everything needs consistent effort. Everything need a little longer vision, not an near-term vision, right? So I think from a listener point, one message I would like to keep is, when you find a company which is a very aspirational, wants to do something of a very India has never done it, right? I think time is a very important essence. We need to give sufficient time to founders to execute what they are seeing, And if nobody paid given time, I don't think people have taken the benefit of NVIDIA. But the people who have been very patient, right? They allowed the company to invest. Then finally, they allowed the investment to turn to sales, and sales to profit, and profit to the stock market price. But having said this big wealth creator story, right? It comes with its own challenge, and one of the biggest challenge which we can turn into opportunity is the volatility in stock price. So when we say 1,000 bagger, 100 bagger, or a 10 bagger, we think every day the stock has to go up. It cannot fall. No, markets are extremely inefficient at a very short period, but they are very, very efficient in the long period. And no better data for an NVIDIA where the stock has fallen close to 80% odd from the highs 4 times in last 20 years. It means there was always a period where NVIDIA traded at 100, went to as low as 20 rupee. Think about, you put a crore, the value goes to 20 and then come back. So this is one such stock where the market keep changed its opinion for a very short period, but on a very long period, you saw the customer who or the investor who held on to the stock made 1,000x. So any good stock also can correct. I think that's a message which I would like to pass it on. The second the message I want to pass it on is not every volatility is risk. There are definitely, when the stocks correct, a good company can correct, but they'll come back, like in NVIDIA. In a bad company, when they correct, they'll never come back. So this is a thin line which we need to understand. If you're in the right company and the stock corrects, right, you don't have to panic. But if the company is really bad and start correcting, right, there is no better way than exiting this company. So my humble submission is, when you see a stock has gone to a drawdown phase of 30-40%, instead of concluding saying, oh, this is a bad stock, we should ask some basic question. Okay, right, are they investing into the future? Are they growing their sales? Are they growing their operating profit? Are they growing the PAT and the free cash flow? If you find very relevant evidence which is true, this is not a bad company. Maybe it's going through a temporary, a weak operating phase, that which NVIDIA has gone through, right? Such a wealth creator have gone through such correction. I think every company is bound for a correction. So how do we find such moments, right? So the natural question can come to the listener is, okay, Balaji, it is very good to see how NVIDIA has built the business, how much money they have put in R&D that resulted in sales growth and operating profit. Obviously, it has come with its own volatility. We have seen everything. But the natural question comes next is, how do you think about finding something which can potentially lead to NVIDIA moment? If we know clearly this stock is going to become like an NVIDIA, right? We're going to invest only in these stocks. So that's not the intent. The intent is, can it provide an opportunity to become an NVIDIA moment? That's my objective to find. So there are three framework which I would see you should look in. First one is a mispriced asset and a sudden rise of a demand explosion, right? So there are sectors where clearly we believe the next India's 3 trillion economy. So we are roughly 3 to 3.5 trillion GDP economy. The next 3.5 trillion could be very, very different. And there could be definitely few industries in an extremely inflection point, right? So typically you see when the industry seasoned by 20-30 years and becomes part of the main curve, right? The growth actually accelerates. And we see few industry are extremely well positioned where the demand explosion can happen significantly. To connect back, so how can demand can explode significantly? We saw what happened to chemical business, right? Where certain businesses where they build capability over a long period of time, and finally, when the capability met the China plus one, right? When the world believed you need to de-risk yourself from China, and they started giving more business to India, right? When a capable industry met this opportunity, you saw the entire operating metric of a chemical company moved from average to extremely above average. Mega wealth got created in the last 8-9 years cycle, right? So it's always possible where you find a very capable company, currently nothing operating on the business, but suddenly when the demand comes in, right, a capable company and a capable people can capture the demand. And that's what something NVIDIA has happened, right? NVIDIA always created capability on the chip. And when you add AI coming in, automotive coming in, crypto coming in, what happened? they were extremely well positioned to capture this demand, and then you saw the stock doing what it has done. The second one, business has high durability, where the strength of the business is it's very relevant to the society, right? So if you look at businesses today, which is creating, that's what no, what does India is going to consume next, $2 to $3 trillion, and if you are well relevantly positioned, right? So if you look at the logistics industry, we are today extremely lopsided on road infrastructure vis-a-vis water, rail, and the seaways. So I think if you find businesses where the next mega India growth will captured by not only road, but we align more towards green logistics, which could be more of a railway or inland waterways, right? So clearly, such businesses which has a high durable growth will capture and possibly can create something called a mega power law equation or the NVIDIA movement. And finally, you should buy this mega trend. We have to buy cheaply. No point of buying a very hot story today at 80-90 multiples where most of the growth is priced in and no disappointment has priced in, right? So any small disappointment can create havoc in the price. I think if you find some company or some sector has this type of a framework, there could be a potential of making little more money than what we generally end up making in a normal stock. So let's tie all this to a couple of example which we have gone through in the past. So one such example is during COVID. This is an so one of the metric which we keep seeing is I consistently read this old newspaper to see what was spoken, what was widely discussed in the public media, and how it played out after 4 to 5 year period, right? So if you look at this came in May 18, 2020, roughly close to 3 years plus back newspaper article. No comfort in hotel stock, recovery pushed to FY23. So expectation of a slow recovery, high fixed cost. So there was so much of clear facts have been called out saying don't get into hotel business. It's bad, COVID is shut, all so on and so forth, right? Nothing against this paper. This was widely circulated in multiple papers. We just picked up randomly this. But investing is more about counterintuitive, right? When 5 crore people are going to read the same thing, right? So it's actually an obvious. What a newspaper calls out is a very obvious, but investing sometimes is going slightly outside your comfort. So what we saw is if someone exactly invested into the well-known hotel companies when this news article hit, right? What happened to them? So interestingly, two things happened. Market itself has delivered phenomenal return during this period of 95%. Um, but if you look at hotel companies, right, most of the hotel companies have delivered to 100% to 200%, and few hotel companies have delivered even 300%, right? So the only submission is it's good to read newspaper to know few opinions, few facts, but we need to go back and test it. And one of the way we think about is there is so much of history out there, right? So and it gives you one good evidence about when everyone believed this is bad, the market price is corrected to such an extent, the risk to reward turned actually favorable. And that's what happened in the next 2 years, where hotel business did significantly better than the actual market, right? So sometimes investing is very much counterintuitive. So today, when everyone thinks everything is good, yes. But sometimes you have to ask, if everyone knows everything is good, what is not priced in is what's the risk which we can end up seeing in next 1 year, which market is not talking today. And one clear risk which I want the listeners to take back again is we are heading into a general election in a couple of months out there, and definitely there are going to be few swing factors. We know for sure there is going to be a lot more noise than what it is today on elections. So we have to prepare a portfolio where we have to go into the storm and come out of the storm very strongly. So I'm not saying can we predict. I don't think we have any ability to predict which government will form the government or so on and so forth, which party will form it. But what we all know for sure is in next 12 months, we have to get into the storm and come out very strongly. And once you start thinking like that, you will be able to build your portfolio accordingly. The second one is a very daily used product, right? I said when you have durability, you can create a lot of wealth. So when we looked at global data of 1,000 baggers or a big wealth creator, One of the name which came out astonishingly strong wealth creator is Monster Beverage. If you look at this company is the highest wealth creator across the world. It's not the Apple or a Netflix or a Google or an Amazon. I think they are a fantastic company. They have done extremely well. But if you look at Monster is the biggest wealth creator, and that primarily comes from a very simple product sold in every country, right? So it's an energy drink. It's a two-player market typically between Monster and Red Bull. Red Bull is an unlisted company. Monster is a listed company, and they've done extremely well in the 40-year period by doing simple things consistently over a long period of time, right? So you don't have to create wealth by only buying some tech stuff. You can always create long-term wealth by buying few simple business which has a great management and know how to grow not for 1 year, 2 year, but 1 decade, 2 decade, 3 decade. And I think someone can compound capital at 35%, right? To put in perspective, Mr. Buffett compounded capital between 20 to 21% over a long period. And if someone can compound capital at 30, 35, right, you know the amount of compounding effect seen in our portfolios. So what's the investor dilemma is how do we participate in power law? And that's what precisely our attempt in one of our investment philosophies. How do we harness this beautiful opportunity to create sustainable wealth, right? So the investor objective is multifold. One, they want to maximize return. I think it's a very reasonable expectation. But how much to maximize is a question. They want a portfolio to be well diversified, but not over diversified. So I think adequate diversification is something which we really desired for, and a portfolio where highly liquid. So that's where PMS as a solution, a personalized solution comes into play, where we build portfolio given when do you come into the market and how well you contribute, because every individual portfolio is slightly a bespoke. It's not a cut copy paste where you just buy into an existing random of ideas, right? So in a way where the entire performance is equally attributable by the portfolio manager, which is us, and the client, who also adequately supports by giving consistent capital into his portfolio. And we build a very bespoke model using the PMS platform. So to quickly run on how we are using the power law in our philosophy, we clearly have four metric in terms of house philosophy. We are long-term focus as a house. What do you mean by long-term is also a very good definition. Is in our view, typically a 4 year is a very good window to think about taking decision. So as an house, we have clearly institutionalized our time frame of every single decision of investing into our core product and multiple products is keeping 4 year perspective, so that we bring capital from investor 4 years. We allocate that capital to a right set of company with a 4 year perspective, so that there is a right expectation of the provider of the capital and the receiver of the capital. We are slightly a non-consensus investor. We would like to buy into a very dominant, high quality business, but in a phase where the market is ignoring, like we saw in the example, right? NVIDIA being a biggest wealth creator of the 2 decades, gave multiple window opportunity where the stock fell brutally for whatever temporary reason, right? So a great company tend to give that opportunity, and when that opportunity present and we are well prepared, we'll be able to. And our style of investing is look for a great company, but buy when there is a short-term disappointment or there is a short-term selling due to some technical pressure in the market. Third, we truly believe bottom-up investing works far more important in a market like in India, where our founders take consistently long decisions which can impact long-term performance, right? So even though we very clearly track the top down, which is the macros of the global and the Indian market, we strongly believe as long as you find a very solid company within an industry where run by very competent people, honest people, and as an aspirational people, right? I think we are good to allocate capital to them. And finally, we believe an economy like India, where the growth is generally given, right? So India is been growing for last decade, also close to 10, 11% on nominal, real GDP between 5 to 6%, right? Our primary jobs comes from not only allocating money, how do we manage risk? And that's a very, very important part of our entire investment journey. So we strongly believe over a long period, by taking lowest risk, you can actually deliver sustainable higher value. So we are not in the camp of thinking you should take high risk to deliver high return. Actually, by taking lower risk, avoiding big accidents, you can have a very smoothest journey and a very safe and a very happy journey of investing. And I'll share the numbers also that will reflect how we are able to attain taking low risk and still delivered reasonably a very good healthy returns. So one of our flagship product I'd like to touch upon, tying to what we are on the power law and the philosophies, a Solitaire, which is a 640 crore fund as we speak, some roughly between 620 to 640 crores. It's a customized portfolio. It's a multi-cap strategy with a very customized portfolio where we build portfolio based on when the client comes in and how they give money after the initial, right? So we are a D2C brand. So we have an active engagement with client so that it doesn't stop with the first transaction, right? Whenever we find a lot more opportunity, we engage with our client and see how we both can build a very good portfolio using the opportunity of the market. The second one, the biggest USP of Solitaire is it's only one product in the country where the entire portfolio is built without a banking. Why it is very important, if you look at every multi-cap, flexi-cap in the country, right, they typically invest between 30 to 40% in a bank. So what we have built is we have built a portfolio absolutely without a bank, which is unique, which also comes with a high quality because bank is typically a high leverage business. For every 1 rupee of equity, bank typically borrows 5 to 6 rupee, right? So there is a lot of debt, but that's a business model. So if you look at Solitaire as a portfolio, typically 80 to 90% of the portfolio is debt-free portfolio. Extremely robust, solid balance sheet portfolio is what we have built in Solitaire. Third, we typically look into business of the future, like how we consistently look for business which is more relevant for the next 3 trillion of India and not the past 3 trillion. And we consistently try to align our portfolio, giving 4, 5, 7 year view and not taking only a near term 1 month or 1 year where some industry which is not doesn't have structural tailwind but as a temporary tailwind, and then you end up buying it. We tend to not to buy such ideas. We tend to choose ideas where clearly the next 10 years growth trajectory is extremely clear and the company is well positioned to grow. Fourth, we'll be a very opportunistic buyers in terms of there is one tendency in the market is as soon as you do a research, you end up taking an action, either a buy or a sell. We strongly believe research is a separate function and investing or buying, selling is a separate function. So if you look at one of the few very great ideas which we bought in now, their work has been done in 2020 and 2021. So we believe you should study good company, but if the price is not appropriate, right, it could be in the pipe list. And as soon as you get a price where you think the risk to reward is favorable, that's where we end up buying it. So we strong believer of you have to buy a good asset at the right price and not buy a good asset at any price. I think that's something differentiate us from a lot of people. And finally, low churn. We also believe once you do a good job in terms of ideating a good idea and building a fantastic portfolio, given how you think next 4 5 years and how your portfolio is positioned, you have to continue to monitor it, but you don't have to act on every news flow, right? So our churn is pretty low. On an average, our churn is close to zero point 0.2. And in the last 1 year, actually, our churn is even fallen close to 0.15 or 0.12, right? Clearly reflects we are trying to hold stock for more than 5, 6, 7 years, right? So that reflects tying to our philosophy of we are truly a long investing portfolio managers. One such example to illustrate all the philosophy and tied to is ITC. This is one random example, right? Disclosure, we still own the position. Some bit of a selling just happened, but if you look at, we have been owning ITC for last 4 year period from the fund inception. But the year one, which is in the 2020, right? Financial performance was weak, stock was weak. But if you look at 2021, the financial started recovering, but the stock did not recover. And that's what the big window always given by this company. And finally, you saw eventually the stock price is today reflecting far more than the fundamentals, right? So this is one such example to say, as long as you buy a good company and you have ability to give time, right, there is definitely reward. Now the natural question can come to all of us is, oh, was ITC was a good company? And I'll share some data to say why ITC was always a fantastic company to start with. if you look at this, this is one of the small data point we track. We have a very deep work on every single stock called mother document which we prepare. ITC 6 month rolling sales, right, consistently been growing across last 10 years, right? So clearly reflects the first P&L item has been growing. And it is not only sales, right? If you see on the right side, PAT, which used to be 6,000 crores, now today close to 18,000 crores. So again, PAT has been consistently growing in ITC, apart from a small blip due to COVID. The most important metric of a wealth creation is free cash flow, the money available after all the investment needed for the future business, right? Moved from 4,000 crores to today 15,000 crores, right? Again, steady rise. And always ITC was a very profitable company, right? So if you look at the metric, everything was good. What was actually hurting ITC was a more of a technical factor. The first and foremost technical factor was ESG. The second factor is a potential selling of government from SUTI. So there were a lot of technical factors was forcing the stock price not to go up. The moment these technical factors went out and the fundamentals took charge, you saw the meme stock become a momentum stock, right? So it clearly gives example of if you're in a right company and you track the metrics, I think definitely in a very simple idea like an ITC also money to be made. This is one such example to share it. So we believe strongly a long-term success in any portfolio has only two things to be taken care. If you have a winner in the portfolio, which is not only on the price but on the fundamentals, you keep riding the winner, which is the power law equation, right tail. But you also have to do one more thing is if you see loser, which is fundamentally right, you need to sell. I think if as long as a portfolio manager is very consistent on this philosophy of being very dispassionate on his decision making and taking decision keeping the actual figures, facts, right? I think the portfolio is well served. Okay, having spoken the philosophy and the portfolio, right? Why are we very bullish on the market? We strongly believe next 5-7 years going to be a very fantastic window to create sustainable wealth. What sustainable wealth is between 13-15% compounding over a long period of time, where our average inflation is 5, right? So you compound your money more than 10% over a very long period is a very good sustainable wealth, which we believe. And why do we believe like next 5-10 years could be a good window is one such data. This is top 25 companies profit numbers. And if you look at the color got marked in green is their all-time high profit. 16 out of the 25 have reported the best profit numbers just ending last year, right? Clearly reflects corporate India is an extremely strong wicket and doing all good, right? Sorry, it's 20 out of 25 have done all-time high profit during this ended 23. FY23 been again a rockbuster, not only for top 50, but all the entire BSE 500. If you look at BSE 500, a company, close to 255 company have reported healthy top line growth and the profit growth, right? Which is a very, very good universe to be there. But also, right, if you want to invest into next 3 or 4 year, right, the 44 company, which I've highlighted on the left top, where both sales is not growing and operating profit is not growing, right? So temporary problem could be one of the reason, and you might find one idea where out of this 44, which can come into high growth in the medium term. So I think with this data, it's one thing is very clear. There is a very good universe of corporate India is firing in all cylinder. That gives you positivity for any medium-term investor, right? Why this is going to be a buy on dip market, and with the right expectation, I think it's going to be a fantastic phase for next 4 to 5 years. So in sum and substance, what we believe, Indian economy is extremely well positioned, both from macro point and from a perception, given what the world is going through and what the world wants to do with China plus or Europe 1 plus some stuff. Corporate India is an extremely great wicket. After long period, corporate India balance sheet is extremely pristine. Both banking balance sheet is good, corporate balance sheet is good, right? So all the primary pillars of a successful growth country is well positioned. Now it's all about execution. And finally, an area which slightly we have to be mindful is valuation. We believe valuations are slightly above the long-term average. So we need to come with clearly right expectation of returns, which we believe India has delivered 11 to 12% over a 30-year period. So I think anything around about long-term average return of 10, 12 from a market level a well-run fund can deliver between 14 to 15. Hopefully, that's what our attempt over a long period is a very good set of expectation and slightly long time frame. Since it's an elevated market, we have to keep the right expectation and we have to temper down on what type of a business we buy in. So we believe today is market where you have to keep your seat belts on and drive it cautiously without taking undue risk. Um, just a quick snapshot of the team. We have built a fantastic team in the last couple of years. Shyam was a founder, CIO for all the funds, and then we have 4 fund managers from me, my colleagues Rohit, Rajat, and Niranjan. We have a fantastic research team, and we have a good strategy team, and we have an investment team. So all in all, it's not. It's more like an institution with a very good team, well organized to run the products. Finally, right, how we think about return. There's a beautiful chart which we prepared to showcase. In the long term, the markets have delivered 10 to 12. That's why we keep thinking we have to keep taking our decision, keeping the long-term data. So anything about 12% over a long period is a fantastic return. And if someone can achieve with lower risk, which is what our endeavor in ithought, I think we are well served to do to our investors. So what we have delivered, obviously, right, the proof of the pudding in eating, Solitaire, which is about to become a 4-year completion in this month. We have delivered, we are very happy to say we have delivered 24.91%, all after the fees and expenses, but pre-tax, over the market at 19.54. What we really are very happy is this performance has been done with a very low risk in terms of quality of balance sheet, as I told. Solitaire predominantly a debt-free portfolio, right? So a very high quality portfolio with low beta, around about 0.72 to 0.75 beta, right? So the portfolio is close to 25% lower risk than the market. Still, we delivered reasonably higher return than the market, right? So, and we are very, very happy in the last 1-2 years where the volatility was significant. And if you see last 2 years, right, the fund has done 23 over the market 13, right? Clearly reflects, I think, long-term expectation of market return is between 10 and 12. Our endeavor is to do 14, 15, and I think God has been very kind and we are able to achieve little more better than what internally we envisage. It's been a consistent performance across the time frame. True Blue is a pure large cap fund. It's around about 2-year old. If you adjust the risk, it's still done well from inception. And last 2 years and last 1 year, slowly the house philosophy is getting reflected in the fund. We have small and mid cap Vriddhi, again a rockbuster. If you look at from inception, the fund has done far significantly well. But I think these are early periods, but we have done extremely well in this period. And Spear, which is our in-house product earlier in RIA, we moved into PMS, and again a very wide set of a consistent performance. In all the 4, one thing is very clear. We strongly believe you take lower risk and try to deliver sustainable value. I think there is some evidence on this data. Happy to take. Thanks for your time, and we'll be very happy to take questions. Thank you. We'll open the floor for questions. Tell us more about logistics sector growth. What about air express growth? So there are very few company which specifically what you're talking about, but broadly, I think logistics is a very, very important sector from overall India growth point. And if you look at our logistic cost is 4 to 5% more than a historical what the world average is, right? So clearly government has put out a big task plan in terms of how do we become very efficient both at the road level and obviously using the multimodal transportation. So what will happen to us is we are very skewed towards road transport in the next 5, 10, 20-year period. India wants to move out from a heavy dependence on road to the other form, which brings 2 things. One, the cost of other logistics will go down, right? I mean, in terms of if you look at seaways, one of the very cheap, right? So that's one thing, right? You reduce the cost. The second and most important thing is it will be more eco-friendly, right? In terms of the emission, all that stuff, right? So I think clearly this is a very, very important sector. The relevance of logistics will become far more in next decade because we are becoming a manufacturing economy. And second, we are also trying to export, right? So if you tie everything off what's happening at emission level, green logistics, manufacturing and export, right? Logistics is going to play far more important role in next decade than what it played. And I think we are very, very positive. Obviously, it's a sector where few companies are listed. It has a mixed number, so you don't have bigger number to call out, but we are very positive and few names are already in our portfolios. Nice concept. Looking for more like this. What is the minimum fund requirement? Sir, every PMS as per regulation is 50 lakhs. So that's a minimum for any fund. That's as per regulation. And hope that answers your question, sir. The next question is, could you please share some example of investing in the business of future? What are the main theme industry you bet on? How much of your portfolio allocation in the small cap space? So investing in the business of future. So let us just take a small example of in the past, right? During 2020, we were a very early investor of a EV software company. The stock was trading between 70-80 rupee, went to 30-40. And in the last 3 years, the stock went up like 10x, right? So we eventually sold out almost everything around 700 odd. So clearly, it gives you an idea about right a portfolio where you know that EV is coming in, but in most of the EV and autonomous, right, software is going to play a big part. So that is one thing which we played out. Today, we strongly believe one of the area we are very, very fascinated and we see next 10, 20 years, big growth will happen in wealth management. The last generation used to have all the wealth keeping in it could be land or a gold, bit of FDs or FD from a conservative point, right? We see clearly this shift will happen in next 10, 20 years where a lot more wealth will be kept in financial assets. And I think wealth management as an industry will become very, very large than what today we are envisaging, right? And if you see, a couple of players got recently listed, and definitely that gives you an idea about how you can be more you can build your portfolio given what next 10, 20 years requirement and then not what was needed in the past. So clearly we are very, very positive on wealth management. We are very, very positive on asset management. We are extremely positive on general insurance, right? Again, as an economy, we are going to become a more of a manufacturing economy and an export oriented economy, right? So clearly, general insurance relevance will go up significantly in next 2 to 3 trillion India GDP than the past. So I think this gives you a good idea, hopefully, on where we are positive. Small cap today, at the aggregate level, we are close to 50%, 40 to 45% in small cap. But small cap itself has become very large, right? So today, every company less than 17,000 crores of market cap is considered small cap. So they are not very small, but it's a very good composition of a large cap, around close to 30%. Then you have mid cap and then small cap, close to 3 to 4% of cash. Do this fund also buy unlisted? No, sir. The entire fund, Solitaire or all the products is purely into the listed space. We don't deal with unlisted. Is Solitaire the best way to play concept of power law? Will Vriddhi will also have the same philosophy? I think it's not. I think as a house, we strongly believe you need to have power law within your thinking. And I think all the four products try to capture. Um, all the four products are very different genre. If you look at Solitaire, it's an extremely balanced portfolio of a multi-cap with large, mid, and small. Vriddhi is a very, very, what to say, a specific small and micro cap portfolio, right? Slightly higher on volatility risk, but definitely the potential of return in Vriddhi is a little more higher, obviously, right? Because of your market depth is a little more shallow, right? So a lot of hard work goes into it. We have two fund managers out there. They worked with Mr. Rakesh Junjunwala, late Rakesh Junjunwala. So it's a great product. In the current market scenario, which sector will come in monopoly stock during coming decade? I think every sector monopolies happen. It is not that a particular set of stock only can become monopoly. What we need to see is this monopoly is also not you got because of regulatory tailwind, right? So there could be few business become monopoly because of a regulator did not allow the competition. I think we would consider that's a weak monopoly. A monopoly where the customer actually love the product, right? So think about Apple. Nobody is forcing anyone to buy an Apple, but I think there is always this aura around Apple, right? Why? The customer loves it. It's a natural monopoly. So when you think about monopoly, we need to ask this basic question: what costs this monopoly is more important than monopoly, because that tells you how long you can make money and how difficult to replace you. I think every sector provides that. You don't have to only necessarily invest into monopoly, but you need to have company have that character where you are profitable, you can redeploy the capital, and you can consistently grow the capital, right? So that's what the character. Obviously, if all these things happen, you tend to make a slightly disproportionate wealth than what a normal market end up giving it. Hope that answers your question, sir. Question from YouTube, Rajshekar. How much period it takes to deploy 50 lakh when starting PMS? Very good question, sir. Today, if you look at our new client, we are deploying between 35 to 40% on day one. If you look at during March, we were deploying between 70 to 75% growth. So clearly, there is a drop-off effect because of, as you rightly pointed out, last 4 months, there has been a one-way street. Markets have rallied more than what maybe anybody has envisaged for. So we are slow. We are very conscious about you should consistently deploy capital given current risk to reward ratio, right? So we take every single decision carefully and see if the rewards are not favorable to the risk, right? We are willing to wait because as I said in the beginning, we are trying to be a 4 to 5 year investor. So if we are running a marathon, we don't want to sprint at the wrong time. And clearly, this is not the time to deploy all the capital. So that's how we are trying to shield our investor. We have been very cautious. Every stock by stock, we want to deploy it and see that buying price is consistent with our investment frameworks. Hope that answers your question, sir. 1 second. Question from YouTube: how a QSR company plays to capture the growth? I think QSR is a fantastic space. I think definitely earlier it used to be once in a month or once in a quarter we used to go out. Now I think if you don't go out every week, it becomes a very a misnomer, right? So I think these industries are extremely in the limelight of a growth. But the question is, which company has a wherewithal to consistently keep the quality of food, how companies are operating in terms of reducing their sugar content or a salt content, right? So all the small things is very important to give a very high multiple to QSR company. Time being, I think they're going through a slight sluggish phase. I think a good window can open up. We are very positive in the long term, but it has to be very case specific. I think we need a webinar of your product, like explanation of each product. Sure, sir, we will organize it. We'll be very happy to take offline also. Otherwise, we will be definitely doing a webinar on a product specific. Some select banking NBFC created good wealth in the past. Does leaving the sector upfront limit our ideas? I think I absolutely agree on this question on avoiding a bank. But what we thought is we can consistently invest beyond banking. I think the 4-year data clearly brings out that you can deliver performance, right? So we have delivered 500 basis over the market without a banking, where actually the banking segment did extremely well on the profit. So what we think is today more than 100 crore population has bank. So India has banked well. India now will do more financialization, which could be wealth management, asset management, life insurance, general. That's one. Second, we also want to create a very differentiated portfolio so that from a customer point of view, you have a very complement portfolio and not a me too portfolio, right? If you look at almost all the mutual fund as banks, so someone will have HDFC Bank 9%, someone will have ICICI Bank. So instead of buying the second fund from a mutual fund, Solitaire can complement at the client level, right? So you have a portfolio with bank and you have a portfolio without a bank. I think that's what we thought a client wants it, and I think Solitaire gives that solution to the client. Obviously, it's a limitation, but we are working with that limitation, and hopefully, so far we have done a very good job. What this also brings in is the portfolio beta goes down substantially because the leverage of the portfolio goes down. So I think there is a good trade-off of not being there. In other products, we do invest into bank. It's not that we are against bank, but we believe we need to have our own unique identity. I think and Solitaire is well served for people who want that bespoke portfolio without a bank, right? That's what Solitaire is up to. Hope that answers your question, sir. Is it good time to invest in workforce management company? One company earnings call, I heard manufacturing sector hiring growth was increased. I think manufacturing is firing in all cylinder. We were there in the AGM of yesterday, one of the very large MNCs putting out a plant to export to Europe, right? So clearly manufacturing in one space firing, but from a valuation point, it's pretty expensive. We have to be very careful on how much to pay up for a company which is economically very sensitive. Workforce management, I think it has to be very case specific. We don't own any position, But as long as we find a company which is growing the top line converting it to PAT to free cash flow, and they are paying out well, right, we'll be happy to invest. But so far we are not able to get any idea to our comfort. Currently, which industry is good for contra bet? I think if you think about asset management company, right, a couple of months back gave a very good opportunity due to regulatory things where the stock got corrected and the stocks were available for a free cash flow yield of 5 to 6%. Today, we believe there are few more companies where there is a ownership change has happened, or MNCs are bringing little more product from the parent, and it's still not recognized by the market because of COVID. What has happened, right? The full effect of change in ownership or change in new strategy is yet to be seen. I think there are still few pockets out there, and that's what we are working on. We have invested in few of the names. Otherwise, broadly, market doesn't have many contra bets. So yesterday I was in one of the Twitter space, and the question came on spec chem, because that's one of the area where a lot of conversation on contra. I think these are early days in that industry, we believe, because capex is happening. So we have to see how does the depreciation impact, interest cost impact happens on the P&L, how markets is able to digest it, right? So there are few areas today still available, but that market is not giving a lot more opportunity today. But I think market can just give us that window. We should just prepare on a right sector and right company. When market corrects, you can just go and deploy it. Does PMS invest in global stock? No, we don't invest into global stock in any of our four products. Hope that answers your question.